Right, okay. Good morning, good afternoon, and good evening to everyone. Welcome to the latest edition of the Trading Vault. I hope you're all doing well. If you could please just as always, just do an audio visual check. If you can let me know that you can see me, let me know that you can see my screen and hear me okay. Also, as always, please introduce yourself. Let me know where you're calling in from, what your sort of experience is in trading, whether you're a beginner, whether you're experienced, what you're looking to get from these sessions. All of that information would be great. You've got a QR code there where you can actually sign up for a VT Markets live trading account. So please scan that QR code as well. And also, as always, if you could stay on the call at the end, there will be a short questionnaire and survey for you to complete, which will allow us just to really make sure that we're getting the information and the topics that you guys would really like covered to give you the best value out of these sessions as well. So, right, okay, so we've got Vancouver, Cape Town, Malaysia. So already we've got North America, Africa, Southeast Asia, brilliant stuff. And obviously I'm here in the UK, so we've got all continents covered. Philippines as well, brilliant stuff. Cool. Well, look, as I say, welcome to the Trading Vault. Please do scan that QR code, as I say, on the welcome page. Great to see so many of you here. I'm sure many of you have already been to some of these sessions as well, so I hope you are finding great value in them. Um, Today's topic is going to be about supply, demand, and scalping. Okay, so we're going to start off with just a very short sort of presentation, just talking about what supply and demand is, and then we're going to dive into the actual charts and sort of see how we can then use that information and look at some ways in terms of scalping the market. So we'll talk a little bit about what scalping is when we do that as well. So hopefully you know more than sort of like about 15 minutes or so in the presentation bit before we actually get into some real live chart trading. Obviously the markets are very volatile at the moment with everything that's going on in the world. So I hope you guys are keeping yourself safe in the markets. If you do have any questions as we move through the presentation, as we move through the markets, please do fire them into the chat box. I will do my best to answer any questions that you have. We'll try and leave sort of 10 minutes at the end for any sort of questions and answers, 10-15 minutes at the end for any questions that you have. I will try and answer the questions that are relevant at the time, but I might come back to them a little bit later as well. So please, yeah, fire away with any questions that you have. But as I say, let's get on with today's presentation. Today we are talking about supply and demand mainly, and then we're going to look at some scalping ways that we can use that to then scalp the markets. Okay, so just a quick introduction to myself. As I say, I know most of you probably have been in these sessions before and know who I am, but for those of you that are brand new to it, I am Ross Maxwell. I am VT Markets Global Operations Strategy Lead. It's my role to provide high-level educational content for traders of all levels, whether that be completely new beginners, right the way through to experienced traders looking to take their trading on to another level. So I am personally a professional trader myself and an investment manager, and I've been trading the markets for more than 20 years now, with a career that started in London and Hong Kong, and now I've been an independent trader for 12 years now. It's actually my 25th year since I joined the financial markets this year, so I've got quite a lot of experience across a wide variety of markets as well. I'm an award-winning trading coach and mentor, and founder of Keyzone Traders, which is an online trading education company. So let's get into the actual main part of the session. As I say, quick presentation, 10-15 minutes worth of information before we can then jump into the charts and really get involved with it and use and how we can use the information in the charts. Okay, maybe even hopefully try and get a trade or two this morning. So let's have an introduction. Supply and demand in trading is where institutions are involved in the market that creates strong movement in price. And this is really important, okay? It's not just a reaction, it's not just a movement, it's a strong movement in price. Now, a demand zone is where buyers step in and they become the dominant order flow in the market. Okay, so it's where we see the market enter an area of price. The buyers will step in, move the market away from that price, and that shows there is demand at that level. And a supply zone is the opposite. It is where sellers step in and become the dominant order flow in the market. So again, it's where price moves into an area in the market, the sellers step in, push the market away from that area, and the sellers become the dominant order flow in the market. Okay, so once price has reacted from these areas, price can often react again from the same area in the future. And it is a way of being able to identify order flow and liquidity. And more importantly, it's a way of being able to identify institutional order flow and liquidity, because it's institutional order flow that moves the market. Okay, and when we talk about once prices reacted from these areas, they can often react from the same area in the future. That can also be, if it's reacted as support, then it can act as resistance when it enters that area again, and vice versa, because support often becomes resistance and resistance often becomes support. And we'll talk about that, and we'll look at that in the actual charting examples in a little while as well. So what are we trying to look for when we're looking for supply and demand areas? Now we're looking for clear swing points. We're looking for multiple reactions from a particular area. And this is the next really important bit that I want to try and emphasize, and we'll try and emphasize it more when we get into the charts as well. We're looking for explosive and impulsive moves away from an area, because the more explosive and impulsive a move is away from an area, it shows that the liquidity and the institutional order flow was much more stronger in that area. We want to see price reacting cleanly and respecting particular areas. And we want to see strong areas of support or resistance that have been broken impulsively but have not yet been retested, because that means that there has been institutional order flow there before. And it's this idea of support becoming resistance and resistance now becoming support once it's been broken. So those are the sorts of characteristics, the sorts of things that you're looking for in the charts to be able to identify these supply and demand areas. Because one of the problems that a lot of traders get themselves into when they're trading is that they look for particular patterns. They look to trade the market wherever the market is trading. But we need to be able to trade and place our trades in the same areas as the institutions are trading from, because that is where the high probability trades come from. That is where the markets move from. So we want to be able to identify this in the price action to give us the highest probability trade locations. Okay. Orton says that you was unable to scan code. Okay, I can go back a couple just to allow you to scan that code. If I can, I'll just give you 2 seconds to scan the code. Or the events team have actually put the link in the chat box there. Orton, so if you want to click on that link, you'll be able to open an account with us there. Okay, so why are these areas important? Okay, now they allow us, as I keep saying, to identify the institutional order flow. What happens with institutions is they often leave unfilled orders in the area, so when price returns, it can react again. So basically, obviously, institutions have so much liquidity, have so much buying power or selling power, that it doesn't mean to say that they always get filled at that level for the volume that they want to. And this is why the market moves away. Again, it's just a simple economic supply and demand. If somebody wants to buy, other buyers step in, it can push the price higher. Institutions have levels that they need to participate from, and if they do not get filled at a particular area, they will leave those orders unfilled, and they will leave the orders there so that when price reacts, they can get filled, and again, it creates even more buying pressure when the market returns to that area. So if institutions have seen value in a particular area before, they are likely to see value there again. And areas of liquidity will attract price. Now, price is always drawn to areas of liquidity. This is why we often see that support become resistance and vice versa. It's often why we see these areas of institutional liquidity get attracted again and again and again. And it's often why we see obvious stop placements, the market move into these areas before returning, where we see sort of these liquidity grabs, stop hunters, sweeps, whatever you call them. Those sorts of that market reaction is quite normal. It is actually just the market fulfilling its responsibility, okay? If you the primary function of any market is to facilitate as many trades as possible, okay? And that's whether you're talking about the financial markets, that's whether you're talking about, a fruit and veg market. The actual function of a fruit and veg market is to find a price that people are willing to go and buy fruit and veg from and match as many and sell as much as possible. Find as many buyers and as many sellers and match them at the best price possible. And it's exactly the same as the financial markets, okay? It is the market's job to find as many buyers and as many sellers and facilitate as many trades as possible. So if there are orders and liquidity in a particular area, it is the market's job to go match those buyers and sellers and then return to doing what it needs to do, because therefore it is again completing the function that it is supposed to do in terms of creating as many trades and matching as many buyers and sellers as possible. So I hope that makes sense as to why these areas are always and often attracted again and again. Okay, so how do we use these? So once we've been able to identify supply and demand areas, how do we use them? Okay, now, as I've mentioned, price moves because of the institutional order flow. Okay, it's the institutional order flow which moves the market, not because of a particular pattern. Okay, so we learn all these strategies. We learn, spinning tops, pin bars, engulfing bars, inside bars, 1, 2, 3s, three black crows, three, there's so many different patterns and stuff that we are taught and is thrown out there, okay? But it is not because of that particular pattern that the market moves, okay? And I can tell you this now, the institutions aren't looking for a pin bar and then going, oh, okay, well, there's a pin bar, therefore the market is going this way. The market moves because the institutions decide that there's liquidity there, that there's value there, that their order flow goes there, and that is what moves the market. Now, the supply and demand zones show us where the institutional order flow is through the characteristics that we've just spoken about. We wait for price to enter these areas of supply and demand, okay? And then we can use the patterns as our confirmation and entry techniques, okay? So, and what I mean by this is that a pin bar just on the charts means nothing, okay? If you take every single pin bar as an example, or every single engulfing bar, you're not going to make money, because the edge is not in an engulfing bar. What you're doing is you're taking one solitary piece of information, one candlestick's worth of information in a chart that may show, 3, 4, 500 candles, and you're trying to make a decision based on that. Whereas if we enter the zone of supply and demand, and then you see an engulfing bar, what you're doing is you're seeing the supply or demand area as your edge, because you're taking the whole picture, the wider picture of that 400 or 500 candlesticks, and you're identifying where the institutions have stepped in over all of that information that's on the screen. And then you use your pattern, so your engulfing bar or your pin bar, to create the entry technique. So the pattern is the entry technique. The supply and demand areas is what gives you the edge. Okay, so I hope that makes sense. Please let me know if that makes sense. If you've got any questions, if that doesn't make sense, please do let me know, and we can maybe look at some opportunities and some examples of this when we actually jump into the charts. Okay, now by using this as well, this sort of like supply and demand areas, we have clear stop placements because beyond the zone where the zone would be invalidated. So once we've identified a supply or demand zone, we know that if price moves through that zone or that area, then the institutional order flow is no longer there. Therefore, we do not want to be in that trade anymore. So it gives us a clear area or clear placement of where our stops, where we want to be out of the market, where our trade idea is invalidated and we don't want to be in that trade anymore. So another thing that creates a lot of confusion when traders start getting into the market is where should they place their stop, and they want to be often they get stop hunted, or the liquidity grabs happen and they get taken out of the market through, and it creates frustration. So we want to be by identifying these zones of liquidity, of supply and demand, we can then have clear stop placements in place. So it gives us another parameter of our trade to know when that trade is invalidated. Paul says, can we show it on a chart? Yes, 100%. We are going to go into the charts in hopefully sort of the next few moments. We should, and now when we're placing our stops, we want to allow enough room for sweeps and liquidity grabs as well. Okay, so the biggest mistakes that traders make, okay, one of the first ones is that they plot their zones of liquidity too large. Now, we should be looking for clean zones that react around the base or top of a move. Large zones create poor risk to reward trades and erode our edge. Because again, if you think about it, you want your stop beyond the zone. If you enter at the bottom of the zone and you have your stop outside the top of the zone, the wider the zone is, the bigger the stop is. Therefore, the bigger your target needs to be to create your risk to reward. So it produces poor risk to reward trades. If the zone is too wide, it also suggests the price is not clean and it should be avoided. And we only want to trade the best and most high probability areas. So just because you go and look at a chart doesn't mean to say you have to trade on that chart. Okay, you need to be able to look at a chart. If there's not an area there, or if there's not a clear area of liquidity there, you need to be able to walk away. Okay. Um, Now, just a quick tip. I personally use the average true range to determine a rough guide to the size of the zone, and it should be about half the size of the ATR 14 period on the execution time frame. And again, we can look at this. I'll show you how to add it to your charts. We can look at it, what that looks like when we jump into the charts in a moment as well. One of the other ones that people make a mistake on is they don't pay attention to the strength of the move. And as I've spoken about this already, they see a reaction and they just think that's an area of liquidity. Just because the market creates some sort of weak swing point doesn't mean to say there's institutional liquidity there. Institutional flow or an imbalance in order flow should create a strong and impulsive reaction. A weak reaction suggests weak order flow, and we don't want to be trading with weak order flow. We want to look for the strong reactions with strong order flow, okay? You generally see larger candles and you see clear momentum from that area. Another mistake they make is that they trade zones which are already exhausted. So whilst we are looking for multiple touches of areas, often the strongest reactions will come from untested areas. And each time an area is touched, orders get filled and liquidity disappears. Now, if the reactions from a zone are becoming weaker and weaker, therefore, so we've got a demand zone. The market moves into that area, really strong reaction. Market comes back, and we get another strong reaction, but it's not quite as strong as the one before that preceded it. Comes back into the area, another reaction, but it's not quite as strong as the one that preceded it. Then you're getting weaker reactions, which shows you that the buying is drying up. It shows you that the institutional order flow is getting weaker, and therefore we don't want to be trading these zones either. So just because there is a strong reaction historically, if there's been multiple reactions and those reactions are getting weaker, that is another area that zone is becoming exhausted, and therefore we do not want to be trading it. If you see an area where the reactions are still strong or maybe even getting stronger, then those are the areas that you can continue to trade and target and attack because there's still strong institutional liquidity there. If the reactions are weaker, then we should avoid these areas. Okay, so final slide before we jump into the charts. There is also an article that is going to be posted in the chat box there around scalping. So please do make sure you click on that link, read through the article on scalping. We're going to talk about scalping as well in a moment. We're going to be focused when we look in the charts. We're going to be focused on scalping. Obviously supply and demand can be used across any time frame. And any style of trading. Just when we jump into the charts today, we are going to be focused more on scalping the markets. Okay, so just a quick recap. Look for confluence factors between previous swing high and lows with clear and strong reactions. Look for liquidity sweeps or liquidity grabs. If you're a day trader, so especially like I said, we're going to be talking about scalping. Look around session highs and lows; they can often create liquidity areas, and you want to try and stay with the overall trend direction as well as much as possible. And you're looking for a confluence of all of those factors. Okay, so Forex says usually after how many touches, then we don't use the zone anymore. And apparently, Freak guys, the team admin Freak says that the link is not working. It's coming up with a 404 error. Um, and Chloe says, yeah, okay, cool. And yeah, the events team have put the link in there for recordings. Um, so yeah, as I say, we're going to jump into the charts now. This sort of supply and demand liquidity can be used across all strategies, all time frames, but we are going to be focused on the scalping strategies today. Okay, so. Can you tell me, can you see my chart there? I'm not sure if you will be able to see my chart screen or whether I need to reshare with the actual chart. Please let me know in the chat box if you can see the chart. Not showing. Okay, yeah. Let me just stop sharing and reshare my screen. Um, right. Okay. Can you please now let me know if you can see my screen? Okay. Perfect. Right. Okay. Now then, with scalping, what we're actually trying to do. So with when we're trading this on higher time frames, you can almost use it as a bit of a swing trade. You can look for strong reactions. With when we're scalping, what we're actually trying to do is just trying to take small movements out of market. Okay, so we're just looking for a reaction, and this is where supply and demand when using supply and demand for scalping can be really, really advantageous because quite often, even if you don't see a full reversal from a particular area in the market of supply and demand, you can often see some form of reaction because there is still likely to be some level of institutional liquidity there, right? So even when you could be wrong, so to speak, or when the institutional liquidity is weaker, you can still profit from scalping the market because we're just trying to take really small reactions from the market. Now, again, what we're also trying to do here is we're using lower time frames because again we want to be scalping is like in out the market, just like literally scalping, just taking a few pips here and there. Okay, so we're generally going to be trading this, and we're going to look today to be trading this on the 1 minute chart. Okay, so there was a question about how many times. Where is the question? Sorry. I think there was a question about how many touches. If some, here, I've lost that in amongst the chat box. If you could repost that question, I will promise to answer it as well. So I wanted to take a look at gold first today, just because I know one, a lot of people like to trade gold. I think it's a very relevant instrument that people really enjoy and like. And two, obviously, at the moment it is quite volatile, a quite volatile market. Okay, so um, what we're looking for here is when we're on a chart. Okay, what we're looking for is strong reactions, clear areas of liquidity. Okay, so at the moment, what I would sit there and say is we're clearly in a downtrend, so we want to look for areas that haven't been tested yet. There's not really actually that many available at the moment, because what we would sit there and say is I would look to the left of the chart and I would go, right, okay. Um, this is probably the easiest way that we can do it. Okay, so we go horizontal line, clear swing area there. Okay, let's clear swing area here. Okay, so these are the areas that I would sort of like be looking to trade from, and you can actually see once price broke through this area here, down here, what do we do? We pull back, reaction from here, reaction from here. This area here, what happened? Broke through, came up, reaction from there. So you can see historically these sorts of things would work. Okay, so if you actually went back in time and just had a look at these sorts of areas, you could see, when price broke through, you could actually have got trades on these areas and scalped these areas. There's strong reactions. Okay. Um, oh, sorry. I say you. Yes. Sorry. I should be doing US dollar. That's what I was supposed to be looking at anyway. So my apologies. Right, here we go. Okay, so this is gold against US dollar. So again, okay, so we can see here we're in a bit of a downtrend on XAU USD. And again, let's mark these up. Okay, so we've got horizontal line again, clear swing point here. We've got a big strong reaction. Okay, we've moved through it. Here we haven't acted too cleanly here, but here we actually have got a really nice strong reaction. But we haven't again noticed that over here the reaction started to get weaker. Okay, so first push up comes back, second time we touch it we get a we get a reaction here. Okay, so how would we look? This is where I say scalping can provide a really strong advantageous opportunity for these areas, because it's not a strong reaction, it's not a really big reaction, but it is enough of a reaction to be able to gain some profits. Okay, so if we add the average true range to our chart, okay, average true range, uh, average true range. Okay, the average true range, it will default to the 14 period. Okay, and what we're looking for is we're looking for roughly how much that is moving, which is about $3.5. Okay, so we would have a supply zone, sorry, demand zone in this area of half of that, so around $1.50 to $1.80. Okay, so if we put in our supply zone, if I can just find a rectangle. Our supply zone now is between $1.50 and $1.80 wide, okay? Because that is what our uh, ATR is. Excuse me. So $1.50. So let's say 497.50. Okay, and now we have an area in the market that we had seen a strong reaction from before, hadn't retested that area yet, looking to buy from that area. Okay, so you could enter a buy in that area. So you'd enter around that zone. You would have your stop below that zone, just maybe a $2 stop, $2.50 stop maximum, something like that. Say even if we say a $2.50 stop, even there you can see you can still get a 3-to-1 risk to reward. Even though the reaction is not very strong, you can still get a 3-to-1 risk to reward winner on that area just from identifying an area of demand before that hasn't been retested. Okay. Once we have broken through that area, I probably wouldn't trade this again from the downside, purely because you can see that reaction has been weaker. Therefore, you're seeing a weaker amount of liquidity in that area. And you can see again here just afterwards, yes, it does hold it. Yes, you probably could have got a winning trade in that area, but the reactions are very, very weak because that liquidity is drying up. Okay, so that is gold. If we're looking for areas in this market at the moment, I can't really see any that haven't been retested yet. Even here, actually. Okay, so there's another area of liquidity there. Yeah, really strong push up. We come down, come through. Where does that market react from? That market reacts from that area. Okay, once we've broken through, it's come down, it comes up into that area, it reacts right from that swing low. You can see it there. This thing will happen repeatedly in the market because the market is constantly looking for the strong areas of institutional liquidity, and that is where you're going to get the strong reactions from. Okay, so what can we do as well with this? Well, as I said to you, if you actually just traded a pin bar, okay, you would be trading. Let's have a look. There's look. So that hopefully, if I really sort of zoom in here, okay, there's a downward pin bar here. The market breaks it, reverses. There's an upward pin bar here. The market breaks it, reverses. There is a negative pin, like a Kia. Downward pin bar comes up, reverses. Downward pin bar comes down, reverses. There's so many. If you just traded every single pin bar in the market on the charts, look, negative pin bar here, reverses. Um, there's so many of them. Negative pin bar here, reverses. A pin bar in and of itself, a negative pin bar here, breaks it, reverses. A negative pin bar or a pin bar of any sort does not constitute a trading strategy that will have an edge and be able to give you that edge in the market. However, if we wait for the market to move into an area of liquidity that we have seen before over here, and then we see the pin bar, you can see this pin bar here, okay? That gives us our entry technique around our edge, okay? So the mark, again, we only want to use this on sort of like 1 minute charts to be able to make sure that the market, if we, to make sure that we're just taking small opportunities and the market hasn't moved too far away from these areas before we're getting into the market. But again, you can be, if you want to be aggressive, you can sell as soon as the market closes, sort of like in that area there. You can have your stop above the reversal pattern, above the zone. And again, look, you've got a really nice, strong 4-to-1 risk to reward trade there on that initial move. It does go further, but you can see that you've got really strong risk to reward trades there, even just taking aggressively. Even if you want to wait for a break of that candle with your stop above there, you're still getting a good sort of 3-to-1 risk to reward opportunity from that. And all we're saying is that we've identified the supply area through a strong reaction previously. This area here, really strong reaction. And then we're using that as the entry technique, okay? So that is gold. Let's have a look at some other charts to see if we can find an actual trade and level to be trading today. Okay, so again, we're going to stay on the 1 minute chart. Let's look at euro dollar. Let's see what we've got here. Let's see what's moving at the moment. Okay, so um, again, what we can do, get a line, okay? If you struggle to like really identify these swing points in the market, just pull a line, pull a horizontal line, or plot one of those zones and just drag it. Okay, so find out where the market is at the moment and just pull it down and find out where those swing points are. You can see them quite clearly. There's one right there, and again, okay, we've missed this one this morning. If we're about an hour too late for this one, unfortunately. But we've got an area here where the market has had a really, really strong reaction. Okay, really, really strong reaction. Market breaks through it impulsively. What does it do? Comes back, retests that area, and pushes away. Okay, so you can either use it as limit orders, um, or you can wait for that confirmation candle. Again, not a pin bar this time. This is an engulfing candle, but you'll see engulfing bars all across this chart that mean nothing. That one from the liquidity area makes gives us our entry technique. You could enter a buy. Engulfing bars, generally speaking, won't offer as good a risk to reward potential, but you can still get good risk to reward trades from here. Look, you can still get you can still get 2-to-1 risk to reward on that one there in the space of, what's that? Half an hour, 45 minutes, something like that. Okay, so supply zone was previously demand zone, right? Yes, exactly. And so often you will find that the supply zones or demand zones, so in this instance, will provide the best orders. So you've got a really strong supply zone here, broken through impulsively. It then becomes a demand zone. You would find these first tests when you get such a strong level will generally speaking offer really good trading opportunities. Okay. Um, So Farik says usually after how many touches already, then we don't use that particular supply and demand zone. It's not necessarily about the number of touches. It's about looking at the price action and the reaction from individual areas and individual zones. Okay, so um, just as an example, I can't really sort of see one here, but if let's say for example, um, okay, here's an idea. Okay, so You can see this is another demands us another supply zone, okay? Because again, we've got really strong move up, resistance, push down. So we've got another supply level around this 114.34, okay? So you can see that there. Now you could have and again, this is why maybe using reversal patterns or techniques is more beneficial, because if you had just placed a limit order, you would have taken a losing trade on this one because it would have been still quite acceptable to try and trade this as resistance, having seen such a strong supply area. But by waiting for the confirmation, you didn't get in this one, but you did manage to get into the long once it had turned from supply into demand. This one here, you've got a really strong supply area. Market moves back into that area. What do? You wait to see if there's a reversal pattern, and you can see there is one here. Okay, so maybe you enter a short trade here. Okay, get in on the close of that. You put your stop above the supply level, and again, you've got a good 2-to-1 risk to reward there. You've got a really nice scalping trade. Again, that's in what 5 minutes. Okay, and you get a nice 2-to-1 risk to reward. Now, I would not then look to trade this zone again. It's not because it's only had two touches, it's because the reaction has been weaker than the reaction before, okay? And you can see that clearly just by looking at that being, sorry, that being what's that? 220 pip move, okay? That's a 20 pip move from the high to the low, okay? This one, however, is just 9 pips. So you can see that the initial reaction was 20 pips. The second reaction is 9 pips. Therefore, the reactions are getting weaker and the order flow is drying up. Now, if this move had continued down and gone sort of all the way down here, then I would still look to trade that as a supply zone again. Okay, because the reaction and the institutional order flow is still showing that it's there because the reactions are stronger. So it's not necessarily about a specific number of reactions before you wouldn't use it again. It's about the strength of the reactions at that zone. It's about what the market is communicating to you, okay? And equally, okay, so yes, we've had a reaction from um, this supply zone now acting as demand, okay? We've already seen that. That doesn't mean to say that this zone, this supply area now is not going to be demand as well. Okay, so if the market moves back into this area, I would be happy to look for a buy as well. So if price moves back, if price moves back into this area, and then we get some form of let's have a look. Just some form of what can we use? Let's just use an arrow. Where's my arrows? And we get some sort of long signaled here. I would actually still be happy to buy that because at the moment this would still act as a demand zone because of the supply there. Okay. Usually after how many touches? Yep. So can you target fixed session VWAP with this providing you are on the correct side of the supply? Yeah, there's no reason why. Again, when you think again, so we spoke about VWAP in the last lesson. VWAP is something that's always going to attract again institutional order flow. Institutions do look at VWAP; they use it as a target. Again, it's probably something that does generally tend to attract. What I would say is maybe manage your um, manage your risk, manage your exposure when using it. But yeah, of course, so using the VWAP can also be used. Can provide gold trading signal after meeting. Okay, so we don't provide sort of signals as such in this session. high 10, but yeah, we've had a look at the gold and having a look at euro dollar now. Hopefully you can find some levels like this. This here is a level that you can look at today once the session finishes. Winnie says for this strategy, it's okay just to use the 1 minute time frame only. Yeah, you can just use the 1 minute time frame. But when you're looking at supply and demand, okay, generally speaking, supply and demand, you can look at it on any time frame. Okay, so if we go to a 1 hour time frame on euro dollar, in fact, there is one I can tell. I can. There's a an area that I'm actually looking at on gold at the moment, which is so if we look at that. We can show you even on higher time frames we can look at this. Okay, there's an area here. Where is my? There's an area here. Okay, that we've seen uh, swing area. That's a demand area. Push up, broken through. I'm still looking for that area to be retested. So we have moved away from this market, this area now, but I can tell you that that is an area. So you can see even on a 1 hour time frame, you can identify these areas in the market, and you can still use it on higher time frames. Just today, we want to look at scalping. So we're just giving opportunities and ideas on how to scalp the markets for now as well. Okay, Winnie? Yeah, so again, yes, a VWAP I would use on indices and stocks. I wouldn't use it necessarily on commodities are okay as well. I would say commodities are okay, probably not as strong as indices and stocks. I probably wouldn't use a VWAP on Forex. Okay, so if you want to use scalping from the VWAP, then yes, definitely focus on your equities and indices. We can have a look at that in a moment as well, like a on an index. Um, and like I said, you could probably use it on commodities as well, but certainly indices and stocks would be better. Okay, so yeah, we've still got about sort of 15 minutes or so left. So let's go and have a look at some indices as well. So let's go and have a look at maybe the Nasdaq or the S&P. Um, Here we go. Let's have a look at the Nasdaq. Okay. Okay. So actually, the Nasdaq is not looking very. It's looking quite choppy. So let's maybe have a look at the S&P 500. There we go. Or maybe the Dow Jones or something. Let's have a look at again, not looking the most. Here you go. Let's have a look at the DAX, something that's actually open now, maybe offering a bit more volatility. Okay, this is offering a little bit more volatility for us, although it's still not particularly clean. But again, you can see here there was an opportunity. So you had a supply zone here. Market moves up, comes down. First test here, you get the reversal pattern and then pushes higher. So, again, first tested, this was just after the market open. Market gets attracted to an area of liquidity, and you get the reversal pattern and you push higher. And again, just there are some areas here. There was an area of liquidity here. Just to show, there's probably what did we get? Came down, got the reversal pattern. And actually, I was going to say that would have probably been a loser, but you probably would have had a winner in that trade as well, actually. If you go for a long position, when that closed, on that close, stop below the low, you've got a nice sort of 2 to 3 R there. Excuse me. Right, okay. Um, can you show an example of supply and demand on Bitcoin on the 1 hour time frame? Yes, we can. Um, Step of using the ATR indicator can be used on it. Yeah, exactly. So for you can use this idea of the 1 hour of the ATR on any time frame. So again, if we're so here's the thing, right? So and this is probably a good example to use. So if we're going to use ATR on the 1 minute time frame, you can look here. This is the DAX, okay? You can see that the ATR is around 20. So we would then want to use a box of about 10 pips, okay? Because we're going to divide that number by two. Okay, so 23. Yeah, well, that is, I've drawn that about 10 pips, actually. Just so you've got that, okay? That gives you a box that is about the right size for the volatility that a 1 minute chart will give you. If you go to a 1 hour chart, okay, that now becomes a zone that is way too thin to accept any volatility, the volatility that you can expect on a 1 hour chart. Okay, so you would need to adjust your supply zone, your demand zone, to allow for the volatility and allow for the movement that a 1 hour chart can provide. Okay, and that is why you use the ATR because that will adjust for the 1 hour chart. And again, looking at this, you now have. You can see the value there is about 180, 175 to 180. So you actually want this on a 1 hour chart to be about 90 points wide instead of 10. So it's 9 times higher. What this does is it allows you to have adjust your stop placements. It allows you to adjust your risk and your stop placements to adjust for the volatility that you're going to experience on the time frame, the asset class, the instrument. So obviously Bitcoin, which has a much higher volatility, by using the ATR, it will allow you to adjust your stop placements for the volatility that you could experience on Bitcoin across different time frames as well. Okay, so it's really important that you use that ATR across the because it will allow you to adjust your volatility based on the not just the time frame but also the asset class and the instrument that you're trading as well. Okay, so hopefully that makes sense. Um, okay, so let's have a quick look at Bitcoin. Um, I'm not sure if we've got Bitcoin on here specifically. Oh, yes, we have got Bitcoin. We've got Bitcoin, Euro, Bitcoin. Here we go. Perfect. Okay, so just let me, yeah, we've still got about 10 minutes, so we're okay here. So supply and demand on Bitcoin. Okay, so again, whether if you struggle with trying to identify these areas, okay, we've got 850, 950 points, so you got one like 500 point wide zone. So let's put in excuse me, sorry, missed that. So that's sort of like your zone. And again, you can just sort of drag this around the chart to try and find the areas. And again, okay, haven't got a real. It's not really clear. So this area here has been tagged. There's not really a clear area that hasn't already been hit. We can maybe look at a higher time frame. But again, here we had a clear supply zone. Okay, really clear supply zone. Such a strong reaction from there. What happens? Price moves into that area, and we get that reaction again as well. Now this one a little bit difficult because if you wait for that reaction, you're actually entering. And this is probably another thing to consider. Okay, if you've already moved a long way away from that zone, you probably don't want to be trading it because you've already missed the majority of the move. Okay, and you can see here, you know, the bottom of that zone is what 73,500. By the time you enter, it's yeah, it's more than 1,000 points away. Okay, so you're probably too far away from the zone. I mean, you can still get a 1-to-1 risk to reward out of this, but if you wanted to go for a 2-to-1 risk to reward, you see how big a reaction you would need from that zone. Okay, so you're not really scalping anymore. You're just yeah, it's just too much. So really do consider the reaction that you've already had from if you're waiting for that confirmation, the reaction that you've already had from that zone, and what your risk to reward looks like before you enter the zone. You don't have to trade every single one of these, okay? Um, yeah, so supply. Let's have a look at a higher time frame, maybe to see if we can get something a little bit better um, in regards to supply and demand. Um, Okay, yeah, we've sort of come this sort of like just looking here, there is again, so there's a reaction there, we've already had it. A reaction here, you could argue we've already had it here. This swing low here on the lower time on the 1 hour would probably be showing. So that is probably the next one around 75,750. That is probably the next area that I can see that when you move down to the hour chart, if we go across, sorry, bear with me. The just taking a while to load. So I'm not sure why this is. Ah, there we go. Right, so here we go. So yeah, you've got this area here that you can see as the swing low pushes up. That hasn't been tested again yet since it's been broken as as a supply zone. So maybe when we get there, if you get a reaction, then that could potentially be a shorting opportunity. Okay, so Maria just asks, okay, the width of the zone using ATR. Okay, so we plot the zone, plot ATR on the on here. Okay, this is this little red squiggly line down the bottom here. Okay, again, what you want to do, draw a line on there. Look for where the majority of these peaks are. Okay, so you're looking at sort of these areas here, which is around 770, up to that area there, which is sort of 920. You take that value, divide that by two, and that gives you approximately what you want to be looking at. So it's sort of like, somewhere around 800. So around 400 points, okay, on Bitcoin is somewhere what you want to use. Maybe 500 just to allow for a bit more volatility if you understand that Bitcoin can provide that little bit of extra volatility. Something like euro dollar, you could probably err on the side of caution and go for a more sort of like 400, maybe 350 points wide. That's like, it wouldn't be that on euro dollar, but you can be a little bit tighter because it's less volatile. But something, if you know the instrument, you understand the instrument, and you know it's highly volatile, something like Bitcoin. The Dow Jones, something like some yen pairs, those experience a little bit higher volatility. Therefore, you want to widen your zones a little bit. But generally speaking, if you just take that number, divide that by two, that will give you an approximate guide on terms of how wide you want that zone to be. Okay, and again, like I say, by using this tool, it allows you to adjust your stops. It allows you to adjust everything based on the time frame and the instrument. Because Bitcoin, it's 400 or 500 points wide. If you wanted to trade it on the 5 minute time frame, you would adjust that down. What's that? 250 points. So you would divide that by two, 125 points. So you've reduced that by 3 or 4 times, okay, because you're trading on a smaller time frame. Therefore, you don't need as wide a stop. You're looking for smaller reactions because of the time frame that you're trading on. You switch to something that is less volatile, like a euro dollar, and again, it allows you to adjust your width of your zone based on the volatility for that instrument on that time frame. Okay, so Frick says, okay, earlier you mentioned the candle has moved too much away from the zone on the hourly one example. Can you show an ideal example of the candle distance from the zone? Yeah, sure. So let's have a look. Did we have something on the Okay, so this one here, okay, we've got a supply zone here. Width of the zone needs to be what's that? 2.6. It's about just over 1 pip wide. Okay, so something in like 1,643. Yeah, that would be about yours. That's about 1 pip. Okay. When we come up, so the bottom of that zone is 143.42. You enter at 143.20. 22 even. Okay, so that's only a pip wide. So it's basically a hit. I guess if I was going to give you a guideline, if the entry is more than the width of the zone, so more than the half of the ATR away from that zone, you probably don't want to trade it. Okay, so it wants to be within that sort of like the width. So if that zone is 1 pip wide, you don't really want to be entering more than 1.5 pips away from the bottom of that zone. Okay, if you're entering 2 pips or 3 pips away from that zone, the market's already moved a substantial amount. Okay, again, you've got to think about where does my target need to be for me to get a good risk to reward trade on this. If I cannot make sense to get a good risk to reward trade, if my target needs to be miles back down here just to get a 1-to-1 risk to reward or a 1.5-to-1 risk to reward, there's going to be much better opportunities for me. Okay. Right, guys, we're going to have to wrap it up there, I'm afraid. We've only got a couple of minutes left. Please do, as I say, please do stay on the call. Answer the survey at the end of the session, just so that we can get a really good idea of exactly what it is you would like us to cover in these sessions as well, so we can tailor it for you. I hope that you have found this useful. As I say, for me, my whole theory and my whole trading strategy is based around these supply and demand zones. Um, so Paul Weatherall says, would it be more profitable to trade these scalps in the direction of the 1 hour chart? Michael, if you could contact VT Markets about that, then that would be best. So Paul Weatherall says, would it be more profitable to trade these scalps in the direction of the 1 hour chart? Yes, 100%. So um, use high time frame for context. You don't want to go too high with when you're using the higher time frame context because it takes it away from what you're actually focusing on. Okay, but yes, by all means, take if you can take it in the direction of the 1 hour chart, that would probably add to the edge as well. Right, okay, guys. Look, we are wrapping it up there. So thank you very much for your time with us. I hope you have found that extremely useful. Uh, and yeah, if you've got any questions, please do pass them through VT Markets, and I'm sure I'll be more than happy to answer them as well. Please register for the next webinar. The link is in the chat box as well. I really look forward to seeing you on that one. Good luck. Hope you get to use this theory in your own trading. And I hope and I wish you all the safety in the current market environment as well. Cool. Cheers, everyone.